how can implied volatility affect IVR? So the question here is, there are different situations. There are different situations in the market where implied volatility, sometimes where implied volatility can be low for a while, leading to very high IVR if there's any movement, or implied volatility can be really high, leading to very low IVR in weird situations. So we wanted to point some stuff out because, like in this market here, implied volatility is really low, right? Across the board. So if you get any kind of an uptick, like for earnings or anything else, you get these really high numbers of IVR. And sometimes this cycle, this earnings cycle is a great example. The moves have been outside the expected move in what feels like in more cases than not. And I kind of feel like the reason for that is because IV is low, so it has had an impact on IVR, and IVR has actually kind of been really high, but it's been a little bit misleading. What do you think about that theory?
Oh, I don't know. That's a tough one.
Yeah.
I don't know. I don't know. You got me.
So anyway, let's take a look, Beth. Let's go. So because IVR is calculated off of one year's past IV, it is important to know what implied volatility is doing along with the IVR of your trade. Like if you look at the last year for what we've done, implied volatility has been low for what feels like a year, right?
Sure.
So with implied volatility super low for the last year, we've been in a situation where any uptick in implied volatility is going to create really high IVR because we've had a low base. Because only
the momentary blip, you're saying?
Yeah, sure.
Well, but it's based off the year, so I don't think that's
it's been low for a year.
Yes, I understand, but since you have so many points of interest, it moves a lot slower. IVR moves relatively slow when looking at all things.
Well, we're going to show you. So if implied volatility was high for the last year, you could get away with lowering your IVR threshold for selling. This is the other side of it. If implied volatility was high for the last year, which it hasn't been, but if it was, you'd get away with lowering your IVR threshold for selling. So this is one full year with the VIX after the VIX spiked over 40. We took an example from like 2009 and 2020, that kind of stuff. And we looked at the average implied volatility change over the next 45 days. And what you saw with IVR is it actually, the higher the IVR, the more it collapsed. It was like kind of just misleading, that's all. It was misleading because the implied volatility had been so high that, you got away with selling low IVR. It didn't hurt you. On the flip side, which is kind of what we're facing right now, if implied volatility has been declining for a while, which it has been, you can't show it. I was going to show a chart of the VIX, but I'm not going. I don't want to switch screens. But implied volatility has been declining now for a long time. It's been contracting. It hasn't had any rallies at all.
No, it hasn't. It's gone from the high, I don't know if you want to call it in the last year, the high 20s to the very low teens.
Yeah, mid 20s to low teens.
That's right.
So if implied volatility has been declining for a long time, like the last year, we can raise our IVR threshold for selling premium. So what we did is we looked at the statistics 1 year following a lull in the VIX, which is what we've had now. Mm-hmm. And the average change in implied volatility over the next 45 days, when you look at this, there's actually when you have IVR,
comparing it to high, it's basically the same.
Yeah. Like when you look at between 30 and 40 and between 40 and 50 and between over 50, you're actually going to see that it takes into account the fact that you essentially have to raise those IVR thresholds if you're selling premium. Mm-hmm. There's just, because it's a little bit artificial. That's what we're seeing right now too. So it's just, It's an example. So let's see if adjusting these IVR thresholds after periods of extreme highs in implied volatility or lulls makes a big difference or makes a big impact to P&L when selling premium. The takeaway from this, by the way, is just going to be that, hey, you just got to keep an eye out for things. Like everything is, we're not changing anything that we do at all, but we're just saying that it's important to just understand the surroundings. That's all.
Mm-hmm. I got you.
Like today, you have Costco with lower volatility than it normally has, but a high IV rank. Just be aware that IV rank is, is maybe a little less enticing than it looks like it is. So we looked at 2009 and 2008.
And that's why the IV rank in Costco, just to give that to you for a quick moment here, is 102, which is even outside the 100, 0 to 100. There's no gates. There's no hard stop at 0 or hard stop at 100 intraday. As you go over, where volatility keeps expanding through the day, when you get to 100, you get to 101, 102, and then it resets tomorrow. If the same volatility were to be on the opening, it would be down to 100, even though it closed at 102.
So we're looking at the SPY in 2009 when implied volatility was really high. And we're looking at 2018 when implied volatility was really low. Okay, we sold 20 Delta Strangles, 45 days to expiration, managed at expiration, to capture the entire 45-day test period. We sold when the IVR was above 10 in 2009. That's 1 year following the VIX trading 85. And we sold only when IVR was above 50 in 2018, 1 year after a lull environment in 2017. We compared the P&L when IVR was selling above 30 in both periods to give you some really good context. I know this is heavy, okay? I discussed it with Anton yesterday afternoon. He's the one that put this together, and he's like, Tom, this is going to be heavy, but and people are going to have to think through it, but it's okay. It's challenging. Let's go to the next slide. So when adjusting the IVR threshold to 10 after a high in the VIX, remember, this is after 2009 when the VIX traded 85. We are then lowering the threshold to 10.
Sure.
We get a slightly lower average P&L compared to when selling when IVR is above 30, but we get nearly twice the trades. That's just the argument here. The whole point here is that after you've had a really high spike in implied volatility, then you get this period of time when obviously IVR comes back down. It wasn't the worst thing in the world to sell premium, even when it got under 10, just because of where it came from, like knowing your surroundings. And it's because you created so many more occurrences. The flip side to this is when adjusting up the IVR threshold after lulls like in 2017, we get significantly better P&L than using our normal threshold of 30. So even though there were less occurrences and waiting for higher IVR, the P&L is much higher. So the suggestion here was when we come out of a lull, like we're coming out of now, you want the IVR as high as you can get it.
Understood.
You want it as high, the higher the better, because if you just go for 30s, it's kind of like the old 10. Like you want it to be at the highest end it can be at in this. You're going to have a little bit fewer occurrences, but you're going to make a lot more money. And this is
have the opportunity to make a lot more money.
Have the opportunity to make more money. 2018 and then the tape action in 2018, trading 2019 is very similar to what we have right now. The tape action in 2023 and 2024 to what is going to lead next. And all the suggestion here is you want that really high IVR. So adjusting the IVR threshold based on where the VIX trades the previous year may have tangible results for your total P&L. If the VIX traded in a lull for a year, like we are right now, adjust the IVR threshold to sell premium to 40 or higher. And if the VIX has just experienced a large spike, you can adjust the IVR threshold to sell premium down to 10 or higher. They're just giving you some windows to expand the IVR threshold so it's not just fixed at 30.
Yeah, exactly. Trying to use a little bit of common sense to the overall process and a little bit of market awareness, maybe a better way of saying it than common sense. Know where we've been with implied volatility, know where volatility is right now, and adjust your own trading to suit those needs. Is that what you're really looking at saying?
No, that is what we're saying. It's it's adding a little bit more market awareness to the whole equation, and that's it.